This is part 2 of the presentation for Module 7 for Accounting 311 Financial Statement Analysis for Global Entrepreneurs. In this learning objective, we will evaluate credit quality and interpret credit ratings. Credit analysis differs from the analysis of equity securities. While equity investors are focused on upside potential, lenders are primarily concerned with recouping the amount loaned together with interest earned on the loan. Generally, lenders will require a higher interest rate as the borrower's credit quality declines. This increase in interest rate is referred to as a risk premium. Earlier in the module, we explained that the effective cost of debt to the issuing company is the market rate of interest used to price the bonds, regardless of the bond coupon rate. The market rate of interest is equal to the risk-free rate plus the risk premium, also called the spread. The risk-free rate is the yield on U.S. government borrowing, such as Treasury bills, notes, and bonds. Both the Treasury yield, the so-called risk-free rate, and the corporate yield vary over time. The rate of interest that investors expect for a particular bond is a function of the risk-free rate and the risk premium, where the latter depends on the creditworthiness of the issuing entity. This slide shows the risk-free interest rate considered to be the rate for the 10-year Treasury bond, the rate for the lowest risk corporate bonds, AAA, and the rate for riskier corporate bonds, BAA, from 2014 to 2019. In addition to performing independent credit risk analysis, lenders such as bankers and bondholders also assess companies' publicly available credit ratings, also referred to as debt ratings, credit quality, or credit worthiness. Companies that want to obtain bond financing from the capital markets usually first seek a credit rating on their proposed debt issuance from one of several credit rating agencies such as S&P Global Ratings, Moody's Investor Service, or Fitch Ratings. The aim of rating agencies is to rate debt so that its credit risk is more accurately conveyed to and priced by the bond market. Each rating agency uses its own rating system. A company's credit ratings provide additional third-party evidence that can corroborate or challenge a lender's independent credit analysis. The overarching purpose of credit risk analysis is to quantify credit losses to inform lending decisions. Expected credit losses are the product of two factors: the chance of default and the size of the loss given default. The chance of default depends on the company's ability to repay the debt, which in turn depends on the company's future performance and cash flow. As a starting point, the lender assesses the company's past performance and its current financial condition to project future cash flows and determine the probability that a company will have insufficient cash to repay the loan. When a company defaults on its obligations, creditors seek to claim the remaining assets owed. A creditor's potential loss depends on the priority of its claim compared with all other existing claims. Lenders structure credit terms such as credit limits, collateral, repayment terms, and covenants to minimize potential losses. The higher the chance of default, the stricter the credit terms a lender will impose. Each credit rating agency has its own unique approach to credit rating. Rating agencies use proprietary models to derive their ratings. All models assess liquidity, leverage, solvency and coverage, and cash flow. This slide depicts the credit rating framework for corporations used by S&P Global Ratings. S&P Global Ratings credit report for Verizon for 2019 will be used to illustrate the credit rating process. S&P rated Verizon as strong for business risk because of Verizon's strong position as the largest wireless provider in the U.S. with a leading brand and reputation for network quality. S&P rated Verizon's financial risk as intermediate. This risk reflected S&P's opinion that Verizon had good prospects to reduce leverage to 2.5 from the current 2.8. However, S&P assessed Verizon's liquidity as adequate, which reduced the anchor rating to the lower end of the range for BBB+. Although most of the modifiers were neutral, management and governance were perceived as strong. However, a comparable rating analysis resulted in a negative modifier. Therefore, S&P assigned Verizon a standalone credit rating of BBB+. S&P Global Ratings cited Verizon's size, strong market position, greater profitability than its peers, and its consistent and transparent financial policy as contributory factors in its credit rating. Constraining the credit rating were the maturity of the industry, which limits growth potential, possible increases in competition, and uncertain cost of future licenses. In September 2013, Verizon entered into an agreement with Vodafone Group plc to acquire Vodafone's 45% interest in Verizon Wireless, giving it sole ownership of the wireless carrier. The deal closed in 2014 with a purchase price of $130 billion, paid in a combination of cash and stock. During 2013 and 2014, Verizon's long-term debt increased from $48 billion to $116 billion. The increase in financial leverage resulted in a downgrade of Verizon's credit rating. In the years following the acquisition, Verizon's creditworthiness has become important as bond buyers look to ascertain the company's ability to manage its debt load, in addition to meeting significant challenges from AT&T for wireless and Comcast on the cable side of the business. S&P Global Ratings concluded the credit analysis with its expectation that Verizon will continue in its stated objective to reduce debt. In this learning objective, we will cover time value of money concepts, including present and future value. Time value of money concepts are important for pricing long-term bonds and notes, understanding the accounting for debt, and other analysis purposes. Would you rather receive $1 now or $1 a year from now? Most people would answer $1 now. Intuition tells us that $1 received now is more valuable than the same amount received sometime in the future. Sound reasons exist for choosing the dollar now, the most obvious of which concerns risk. Because the future is uncertain, any number of events can prevent us from receiving the dollar a year from now. To avoid this risk, we choose the earlier date. Another reason is that the dollar received now could be invested. That is, 1 year from now, we would have the dollar and the interest earned on that dollar. Risk and interest factors yield the following generalizations. First, the right to receive an amount of money now, its present value is worth more than the right to receive the same amount later, its future value. Second, the longer we must wait to receive an amount, the less attractive the receipt is. And third, the greater the interest rate, the greater the amount we will receive in the future. Putting the second and third together, we see that the difference between the present value of an amount and its future value is a function of both the interest rate and time. The fourth generalization is that the more risk associated with any situation, the higher the interest rate. To illustrate present value, we will compute the amount we would need to receive today, the present value, that would be equivalent to receiving $100 1 year from now if money can be invested at 10%. We recognize intuitively that with a 10% interest rate, the present value would be less than $100. The $100 in the future must include 10% interest earned for the year. Thus, the $100 received in 1 year, the future value, must be 1.10 times the amount received today, the present value. Dividing $100 by 1.10 results in $90.91, which is the future value. This means that we would do as well to accept $90.91 today as to wait 1 year and receive $100. We compute the present value of a future receipt by discounting the future receipt back to the present at an appropriate interest rate, also called the discount rate. Appendix A near the end of your textbook includes time value of money tables. Table 1 is a present value table that can be used to compute the present value of future amounts. A present value table provides present value factors for many combinations of time periods and interest rates that determine the present value of $1. To use the present value tables, first we would need to determine the number of interest compounding periods involved. For 3 periods compounded annually, we would use 3 periods, but for 3 years compounded semi-annually, we would use 6 periods. It is important to distinguish between years and compounding periods. The table is for compounding periods. The extreme left-hand column indicates the number of periods. Next, we need to determine the interest rate per compounding period. Interest rates are usually quoted on a per-year basis. The rate per compounding period is the annual rate divided by the number of compounding periods per year. For example, an interest rate of 10% per year would be 10% per period if compounded annually, but 5% if compounded semi-annually. Finally, locate the present value factor, which is at the intersection of the row of the appropriate number of compounding periods and the column of the appropriate interest rate per compounding period. Multiply this factor by the dollar that will be paid or received in the future. This slide illustrates how to determine present value, first using the tables, and also has illustrations for using a financial calculator and Excel. In case 1, we want to compute the present value of $100 to be received 1 year from today, discounted at 10%, compounded annually. To locate the correct present value factor, we first determine the number of periods, which is 2, and then the rate per period, which is 5. The factor is 0.90703, which is located at the intersection of 2 periods and 5% interest. We multiply this factor by the $100 to determine the present value of $90.70. We follow the same process for case 2. In this case, we want to compute the present value of $100 to be received 2 years from today, discounted at 10%, compounded semi-annually. The number of periods is now 4, but the interest rate is still 5%. We find the factor 0.82270 at the intersection of 4 periods and 5% interest and multiply it by the $100 to obtain the present value of $82.27. In the last case, we compute the present value of $100 to be received 2 years from today, discounted at 12%, compounded semi-annually. The number of periods is 4, but the interest rate is 6%. 12% divided by 2. We find the present value factor in the table where 4 and 6% intersect, 0.79209, and multiply this by the $100 to obtain the present value of $79.21. In the first example, we computed the present value of a single amount called a lump sum. Often, future cash flows involve the same amount being paid or received each period. Examples include semi-annual interest payments on bonds, quarterly dividend receipts, or monthly insurance premiums. If the payment on the receipt is equally spaced over time and each cash flow is the same dollar amount, we have an annuity. One way to calculate the present value of the annuity would be to calculate the present value of each future cash flow separately, but there is an easier way. We can use a different table to determine the present value of an ordinary annuity, which is where the payments occur at the end of each period. If the amounts occur at the beginning of the period, we would use a present value table for an annuity due. To illustrate, assume $100 is to be received at the end of each of the 3 years as an annuity with 5% annual interest. Since the amounts are to be received at the end of the period, we would use the ordinary annuity table. To determine the present value of all 3 $100 payments, we would find the factor in the table for 3 periods and 5% interest, 2.72325, and when we multiply the factor times the $100, we get the present value of $272.33. Recall that a bond agreement specifies a pattern of future cash flows, usually a series of interest payments and a single payment of the face amount at maturity. Bonds are priced using the prevailing market rate on the day that the bonds are sold. This is the case for the original bond issuance and for subsequent open market sales. The market rate on the day of the sale is the rate we use to determine the bond's market value. The market rate is the bond's yield or effective rate. The selling price is determined by the present value of the future principal payment at the prevailing market rate and the present value of the future series of interest payments, the annuity at the prevailing market rate. Then we add the two present value amounts together to determine the bond proceeds. In this first example, we will determine the price of $100,000, 8% 4-year bonds, paying interest semi-annually when the market rate is also 8%. As we saw previously in the module, when the coupon rate is the same as the market rate, the bonds will sell at par or face value. The calculation of the present value confirms this. First, we determine the present value of the principal at 8 periods, 4 years times 2 interest periods per year, and 4% interest, 8% annual interest divided by 2 for semi-annual interest payments. To find this factor, we use the present value of one table for a single sum. The factor is found where 8 periods and 4% interest intersect, which is 0.73069. We multiplied this factor times the principal of $100,000 to determine the present value, $73,069. Next, we determine the present value of the semi-annual interest payments of $4,000, which is calculated as $100,000 times the coupon rate of 8% divided by 2. To find the factor for the semi-annual interest payments, we use the table for the present value of an ordinary annuity. We find the factor where 8 periods and 4% interest rate intersect, which is 6.73274. We multiply the factor by the $4,000 semi-annual interest payments to determine the present value of $26,931. Then we add the present value of the principal amount, $73,069, and the present value of the semi-annual interest payments, $26,931, to determine the present value of the bonds, which is $100,000, the par or face value. In this example, we will assume that the market rate is 10%, which means that the bonds will sell at a discount because the market rate is higher than the coupon rate of 8%. To determine the present value of the $100,000 principal payment, we find the factor in the present value of a single sum table where 8 periods and 5% interest, 10% divided by 2, intersect. This factor, 0.67684, is then multiplied by 100,000 to determine the present value amount, $67,684. Next, we determine the present value factor of the 4,000 semi-annual interest payments by finding the present value factor in the ordinary annuity table where 8 periods and 5% interest intersect. The factor, 6.46321, is multiplied by 4,000 to determine the present value amount, $25,853. We add the two present values together to determine the present value of the bonds, $93,537. In the last example, we will determine the present value of the bonds when the market rate is lower than 6%, is lower at 6% than the coupon rate at 8%, yielding a premium on the bonds. In this example, the market rate is 6% annually or 3% semi-annually. We determine the factor for the present value of the principal by finding the factor in the present value of a single sum table for 8 periods and 3% interest. We multiply this factor, 0.78941, times the $100,000 principal to determine the present value of $78,931. $941. Next, we find the present value of the 4,000 semi-annual interest payments by finding the factor in the present value of an ordinary annuity table for 8 periods and 3% interest. We multiply this factor, 7.01969, times the $4,000 interest payments to determine the present value of $28,079. We add the two present value amounts together to determine the present value of the bonds, $107,020. As we mentioned earlier in the module, you can also use a financial calculator to determine present value. There are 5 function keys for these calculations. N for the number of compounding periods, IY for the interest rate per period, FV for the future value of cash flows of a lump sum, PMT for an annuity amount per discount period, and PV for the present value of the cash flows for a lump sum. You must enter the payment and lump sum as a negative amount for the present value amount to be returned as a positive number. The calculator considers these from the perspective of the company paying these amounts, and therefore they would be cash outflows, and the present value would be a cash inflow to the company. The important point is that you enter the amounts for payment and future value with the same sign. To illustrate the use of the calculator to determine the present value of the bonds, we will use the example of the bonds yielding a premium when the market rate was 6% and the coupon rate was 8%. When using the calculator, as with the tables, we will be entering information for the market rate to determine the present value. The number of periods will be 8, which is 2 semi-annual interest payments times 4 years. The interest rate will be 3%, which is equal to the market rate of 6% divided by 2 semi-annual interest payments per year. To calculate the present value, you will press N and enter 8. IY and enter 3, FV and enter a negative 100,000, and PMT and enter a negative 4,000. Last, you will press PV and the calculator will return the present value amount of 107.20. The same process can be repeated to determine the other present value amounts at par and a discount. As we also mentioned earlier in the module, Excel can be used to calculate present or future values. The Excel functions for both present and future value are shown on the slide. There are 6 variables for the time value of money functions. First is the rate, which is the interest rate per period. Next is the number of periods, then payment amount, future or present value, and the type. The type is for the timing of the annuity payment. 0 is used for annuities paid at the end of each period, ordinary annuities, and 1 is used for annuities paid at the beginning of each period, called annuity due. This slide illustrates the computation of the present value of the bonds when the market rate of interest was the same as the coupon rate. The formula includes the calculation of the semi-annual interest rate, B2 divided by B3, and number of interest periods, B4 times B3, so that the annual rates and years to maturity can be entered on the spreadsheet. The formula calculates the semi-annual interest payment as a negative B5 times B1 divided by B3, or the $4,000. Notice the negative signs in the formula for the payment and the future value so that the calculation returns a positive present value. This is an ordinary annuity, so annuity type is 0. Another way to calculate present and future values is to use calculators on the internet. The future value of a single sum is the amount that a specific investment is worth at a future date, if invested at a given rate of compound interest. To illustrate, suppose that we decide to invest $6,000 in a savings account that pays 6% annual interest, and we intend to leave the principal and interest in the account for 5 years. We assume the interest is credited to the account at the end of each year. The balance in the account at the end of 5 years is determined by finding the factor in the future value of a single sum table where 5 periods and 6% interest intersect. This factor, 1.33823, is then multiplied by the principal, $6,000, to obtain the future value of $8,029. If instead of investing a single amount, we invest a specific amount each period, then we have an annuity. To illustrate, assume that we decide to invest $2,000 at the end of each year for 5 years at an 8% annual rate of return. To determine the accumulated amount of principal and interest at the end of 5 years, we find the factor in the future value of an ordinary annuity table, where 5 periods and 8% interest intersect. Then we multiply this factor, 5.86660, by the payment of $2,000 to determine the future value of $11,733. In this learning objective, we will briefly discuss amortization of debt. To illustrate amortization of debt, assume that Verizon issues bonds with a face amount of $600,000, a 3% annual coupon rate payable semi-annually, or a 1.5% semi-annual rate, a maturity of 3 years, 6 semi-annual payment periods, and a market rate of 4% annually or 2% semi-annually. These facts would yield a bond price of $583,195.71, which would round to $583,196. The discount on the bonds is $16,804. The difference between the face amount of the bond, $600,000, and the present value of $583,196. The discount will be amortized over the life of the bonds to yield the market rate of 4% annually using the effective interest method. Verizon would pay the bondholders $9,000 cash semi-annually, calculated by multiplying the face amount of the bond, $600,000, times the coupon or stated rate of 3% divided by 2. The interest expense, $11,664 on the bonds, would be equal to the net bonds payable of $583,196 times the market rate of 4% divided by 2. The difference, $2,664, between the interest expense and the cash paid would reduce the discount on the bonds. This process would be repeated for each of the 5 remaining semi-annual interest periods, so that at the end of the 5 years the discount would be reduced to 0, leaving the principal of $600,000, which would be due to the bondholders. And this is the end of Part 2 of the presentation for Module 7 for Accounting 311, Financial Statement Analysis for Global Entrepreneurs.